Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Alan Wargent Property Buyers, and I'm here with Chris Bates. Chris, how are you?
Things are good, Pete. How's life over there?
Yeah, pretty good. So this is our weekly 2 cent segment, and I'm actually flying to Greece today. So I thought, you know what, let's sneak in our 2 cents segment during the week. I'm actually, because I'm recording this with you today, Chris, on Tuesday. This is actually the day before the inflation figures come out. So by the time this goes to air on Sunday, everyone will know the inflation figures, all the media commentary about what's going to happen to interest rates in August and thereafter. And we're actually recording just on the eve of that. So we're a step behind, I guess, by the time this goes to air. So we'll have to see how that plays out.
Yeah, I mean, I love watching Kook's 2-minute sort of snapshots on the market. If you don't, Stephen Koukalakis, I think is a better way to say it. But he does some really good snapshots. And, he's an advisory to governments in the past, etc. And, he's kind of talked about the storm that's going to get whipped up later this week if inflation numbers don't look that great. And, all the commentary around are rates going to go up, etc. But he sort of says when you look a little bit further out, which is, what we're starting to see around the world, is that inflation is going to get back within the band. And we won't be talking about rate increases. We'll be talking about rate cuts. I mean, I shared an article with you, Pete, which we weren't going to talk about today, but Canada's started to cut their rates, right? That's we're starting to see that more and more around the world. What's your take on things that are happening over there?
Well, I think that's the thing, isn't it? If you look at the US figures, for example, so if you look at their what they call a multivariate core trend, so this is getting very, very technical, but basically it's a measure of how persistent inflation is, 2.06%. So arguably, you could say the Federal Reserve in the US should be cutting interest rates now. And of course, the US has a disproportionate impact on the way things are going in the rest of the world. As you said, New Zealand's going to be cutting interest rates pretty soon. I mean, some of the lenders over there have already gone by 50 basis points in anticipation of lower rates. Canada's already cut twice. UK, not yet, but very close. Eurozone probably along similar lines. So, I guess Lucy Ellis at Westpac wrote a piece maybe a week or so ago saying we're just not that special. So, we're going to get some bumps along the way, as most countries do. But I think, if you're looking out maybe 6, 12, 18 months' time, we've got things like asking rents have actually declined over the past quarter. Construction costs are inflation's at 22-year low. So, there's still a lot of inflation that's sort of sticking around. I think it's things like inflation and insurance and education and services costs. So anyway, by the time this goes to air, you'll know a whole lot more than we do. But I guess generally as a property type person, I try not to get too caught up in those short-term the short-term noise. I try and think about property in 10-year chunks and what's going to be happening a year, 3 years, 10 years from now, rather than reacting to the latest news. Because I think, as we've said on 2 cents before, if interest rates go up further from here, they'll only be coming back down quicker next year because we've got building approvals at decade lows and the economy's really been slowing anyway, with insolvencies probably going to hit a record high this year. So, we'll see what plays out on that. And we'll go through the detail, I guess, of the inflation figures next week.
Yeah, and I think what's interesting about that article about Canada is that it sort of very quickly it was talking about the sentiment there is much more positive. People are wanting to get ahead of rate cuts and, and the real positive flip on the market. And that market's gone backwards over the last couple of years with higher interest rates versus here it's actually gone up. So, you just wonder whether, we're not that far away from that type of article being spread around compared to what's going to probably get spread around late this week as inflation's going up. And what my view is what we've seen just time and time again over the last 2 years is whenever there's uncertainty, listings dry up and buyers sit on their properties, right? So if there is another rate increase likely in the next couple of weeks, we're probably just going to see supply tighten up for the rest of this year. less buyer, less activities. But I mean, for the average household, that there is a bit of extra pain. Whether that one rate increase pushes them over the edge, I don't really believe those type of stories. Ultimately, they would have probably gone over the edge anyway, regardless on this tiny little rate increase. But I do think households are really struggling and are desperate for some rate cuts just for their mortgages. And so I think there's just a lot of pain going on around. That's not compared to prices, right? Because if they're not forced to sell, then they're just getting smacked on their monthly cash flow. So what 3 stories are we going to do this week, Pete?
I think usually when you look at the data, people don't default on mortgages because interest rates go up 25 basis points. They default because they've lost their job. That's really what causes mortgage arrears. And if they can't find a new employment in a timely manner, that's what causes mortgage arrears. An extra 25 basis points for sure is going to hurt, but that's the whole point. It is actually to slow the economy. And you're right. I do love watching the Kooks 2-minute masterpieces. He's an absolute legend, the Kook. He's always good value. If he comes out for a beer, you get him talking about what's going on in the economy. So, Steve, we'll have to get you on the show if you're listening. So, big 3 news stories this week. So, APRA keeps macroprudential settings steady. So, the prudential regulator has said for now things are staying where they are, but they'll be reviewed in due course. Secondly, from 1 January 2025, New South Wales will be changing the no grounds eviction rules. So that's generating a little bit of debate in terms of the possible impact. So we'll take a quick run through that. And then thirdly, something a bit different because demographics are destiny, as they say. From the Japan Times, Japan's population has fallen for a 15th consecutive year, dropping by a record figure of more than 800,000, which is pretty interesting because if you project that out to the middle of the century, unless they start cracking up immigration, there's going to be, probably 40% of municipalities will be gone. They'll be vanished. So very sort of big picture sort of story, that one. But it's interesting just in the context of what it means for housing, not just in Japan, but other parts of Asia, some parts of Europe, and we'll take a look at some of the countries that are going the other way and pumping up immigration. So, Chris, let's start with this APRA story because you're right at the coalface of lending trends with the guys at Flint Group, and you're right across all of this stuff. So, APRA said that it will keep the lending assessment buffer steady at 3 percentage points. They say risks in the economy remain elevated from a financial stability standpoint. Mortgage arrears gradually rising. So I guess what does this mean for the housing market? I guess it will keep supply pretty tight because new apartment sales are going to struggle in that kind of environment. And obviously first-time buyers are going to struggle if they're being assessed for a 3 percentage point buffer. So what do you think? What do you think's actually happening at the moment? Are you seeing any signs of looser lending policies at the margin, or are things still pretty tight?
No, I mean, it's tight in terms of what you can borrow, but they're pretty relaxed in terms of getting lending approved. Like if the deal stacks up, a lender's definitely going to click that approval button pretty quickly. Ultimately, they want lending book growth. And, none of the issues that were back in 2018, 2019 with the Royal Commission around expenses or the issues in COVID around looking at income and not lending to certain borrowers and really hard to borrow if you're self-employed, et cetera. So lending right now is absolutely risk on. If they can get it through and they've got the risk ratings all set up the right way with APRA in terms of where their exposure can be in the market, there's still some innovative policies whether you're employed and using salaries and lower assessment buffers for refinances and et cetera. So if you are in a tight cash flow position, things are tight, but you may still be able to refinance if that's going to be what you need to do to get yourself a bit more buffer over the coming years. Pricing's come back a little bit, so we used to get a little bit better pricing maybe 6 to 18 months ago. And but just in recent times, we've seen a bit more of a price war again, where banks are matching each other and they're looking for lending book growth. So that's great for consumers. There was a period there where a CBA sort of led the way and said, no, we're not going to offer as good pricing. And then all the other banks followed because they were, saying that they were writing loans under the cost of funding. I mean, this APRA thing, I think the interesting thing about this story is it is a story, right? Because ultimately, APRA have come out and commented and saying the buffer is the right setting given where the economy is. Well, who's to say that the next time they don't come out, if there's a lending cut, inflation's under control, and they can really see first home buyers struggling to enter the market, maybe the argument is, well, lending's too tight and we need to support first home buyers in particular to come into the market. And the way to do that is to reduce the serviceability buffer because rates are coming down. So I don't really mind this situation here. I mean, you can see why they wouldn't do it right now, particularly when the housing market is going up, when common sense would probably make you think it should be going down. But I think this could easily be a different story in a few months' time.
I think actually, yes, if you look at what APRA said in the statement, so overall financial system risks remain somewhat elevated. The macroprudential settings are guarding against those risks. So credit growth for home purchases moderated a bit from the highs. Essentially, high debt to income and high loan to valuation ratio lending is now only a very small proportion of new lending. So lending standards remain sound. This is a quote. Banks are able to make exceptions to their serviceability policy when it's prudent to do so. So that's interesting. Arrears are gradually trending higher. But I think this is the key statement. Given the uncertain economic and interest rate outlook, including the possibility of higher cost of living pressures, it is important that prudent buffers are incorporated in serviceability assessments. So this is pretty interesting because at the time of recording, market pricing is for interest rates to be quite a lot lower in 18 months' time, not higher. But I guess until inflation is definitively beaten, I don't think there's going to be any sort of easing. That's what it appears to be saying. So APRA will continue to monitor lending standards, but if we believe a change in macroprudential settings is necessary, we'll make the appropriate adjustments where needed. So that, to me, suggests that we could see the lending assessment buffer cut, but not until there's a definite sign that inflation is beaten and that interest rates are coming back down. Just anecdotally, I've heard a few people say that banks are a bit keener to get loans written. I won't sort of name names on the banks, but Andrew and I were sort of half-heartedly looking at buying some office space at some point, and the banks are actually getting back to us and saying, do you want to get a loan written? And we're a bit cagey about the office market at the moment, and we're not in a big rush. But I think that it's just such a big change from where things were. If you think back to the Banking Royal Commission, when you really couldn't get a loan for love nor money unless it was a very standard type of loan. Anything non-standard was just being given the flick. So there's obviously a willingness and ability to lend for banks, but it's just the actual lending capacities are much tighter.
Yeah, absolutely, Pete. I mean, it's we'll just have to watch this space. But I think if you go back to 2019, it's got all the sort of feel around that, where all of a sudden we're waiting for this line in the sand, and then the line in the sand is actually, no, we've tamed the beast. Inflation's back in the can. And now we're on a rate cutting cycle. And that's when you also could see some more firepower added to that sort of momentum, with APRA stepping in and then a bit of FOMO stepping in. So then demand increases and they've got more buffers and they're willing to stretch. And family want to help because they know that they've seen in the past where markets can move quite fast. And all of a sudden, I do think you're going to find a lot of demand on very low listings. And if you're worried about sort of listing numbers, just take always with a grain of salt the listing numbers out there. They're really low, but when you break it down of what those listings are, you'll find that a lot of them are apartments, and a lot of them have been sitting on the market for a long time because no one really wants them at these prices. And there's very few little quality properties on the market. So you have very low supply and a big increase in demand all at once. And I think a 2019 situation and a 2020 situation potentially is on the cards, but I don't like to forecast too much. So what's story number 2, Pete?
You're right. Things change pretty quickly. Probably even by the time this goes to air, there'll be a whole lot of new information having come to light. So story number 2, New South Wales, an update to the no grounds eviction rules. So New South Wales tenants will benefit from new rental rules from next year with protections from no grounds eviction. So from 1 January. So I guess the sort of the backdrop is here that in New South Wales, landlords have traditionally been allowed to finish a residential lease without necessarily giving the reason for doing so. But under the proposed reforms, there's essentially the government has said in a statement that the landlord will only be able to sort of terminate the lease if the renter breaches the lease conditions, damages the property, or fails to pay the rent. Now, in theory, you could also finish your lease if you're going to sell the property, and if the property is going to be, for example, demolished or there's a major renovation, which would make the property uninhabitable. But landlords will need to give more notice for tenants on fixed term leases. So 60 days notice to tenants on fixed term agreements, less than 6 months, and 90 days to those on leases of more than 6 months. So I guess the overall picture here, Chris, is that this is designed to give renters more certainty. And Chris Minns, the New South Wales Premier, said that bad tenants will still be able to be evicted, but tenants just won't have the axe sort of hanging over their head, which is often the fear. I suppose the pushback has come from Property Investors Council of Australia. Our friends Ben Kingsley over at Empower Wealth is sort of been pretty active on the socials, on LinkedIn and Twitter this week, or X. And the Picker survey shows that most landlords, well, obviously they want to be able to control the evictions process without sort of legal intervention, because in most cases it generally works just fine. And there was a couple of scare story media pieces about a potential fear of mass evictions before the rule change in 2025, which seems highly unlikely to me. But Ben was quite vocal on the socials, saying this is really ideology over common sense, because there are just always some circumstances that could come up. For example, there's divorces, there's been circumstances of domestic violence, or sometimes there are situations that arise where actually it's not related to the tenant's conduct. It's more just a change in circumstances that might need the owner to step in. So there's two different sides to this debate. What do you think in terms of the market impact, Chris? Do you have any view on it?
Oh, I don't think there's a bit of a storm in a teacup, if I'm honest, around it's going to be this mass selling because of these new rule changes.
That was what I thought. As soon as I saw the headline, I'm like, come on.
Yeah, exactly. And, I do think you've got to be careful. Sometimes the commentary out there, can be very pro-investor, and forget that there's two sides to this equation. And there are families that are in these homes that, they'd love to own a property, but they just can't afford to. They haven't got family wealth. They just haven't got the savings. And they're great tenants, but there's also a rental crisis. You've smashed the investor market over the last few years with a number of policies. And, when they go and apply for other places to rent, their application could be squeaky clean, but that doesn't mean they've got as much income as someone else, or, that there's not 5 or 6 applicants that are also squeaky clean. And so I would say, just got to be careful being a bit too investor pro. I think ultimately, renters sometimes have the biggest property stress, I would argue, because, when you own a home, you've got a mortgage stress, but you've still got security, right? You don't have to be worrying about every 6 or 12 months potentially having to move. And, the rental costs have gone up dramatically. Some people can't afford it, so they've been forced to move, and they, the rents have gone up there, etc. So I don't know. I'm probably a little bit more pro-tenant with these sort of things. I think that, investors will have to evolve and just be aware of the new rules. And, to be honest, our tenancy laws are pretty relaxed compared to a lot of countries around the world, I would say. And so, I'm not against these things. I just think that investors now need to just weigh it up, because when they are buying and potentially looking to sell, there's just a little bit more they have to think through, and they just have to be better prepared. And yes, it's going to affect some people at the margins that, that 30 days is a big difference. But I don't think, I think a lot of people are arguing because they just don't want to see more and more pro-tenant, legislation. And so they try to fight every single thing that happens. And I'm not really concerned by this. I actually think it's the more that we can protect our tenants, particularly good ones, the better, rather than potentially turfing them out. It's expensive to move home. You're looking at $3 to $5,000 to move home. You've got disruptions to kids and school zones and their friends and their networks and our communities. We don't really want people moving around a lot. So potentially making it a little bit harder for investors just to kick them out to increase the rent and then get someone else in. I don't think it's a bad thing.
I think you're right. So the pushback is probably a bit along the lines of thinking, if you give governments an inch, they'll take a mile, and then it will be this to begin with, then there'll be something else and something else. I'm just reading the statement from Picker here, and it seems to the argument seems to go, well, yeah, at the margin. I think you used the phrase. That's the key thing, isn't it? I think the mass evictions story, that's BS and scaremongering. But at the margin, it could potentially make property investment less attractive to sort of average mum and dad investors, and therefore fewer rental properties on the market overall. Could result in higher rents. Picker have highlighted some figures from Victoria where the tenancy reforms, along with higher property taxes, resulted in 15,600 fewer rental properties in Victoria over 12 months based on bond registration data. So I saw that when it was reported at the time. I don't know whether this has had a big impact in Melbourne and Victoria in terms of the rental market down there. I'm not close enough to it. But yeah, I guess the Picker's argument is if you keep making property investment less and less attractive incrementally, then eventually you end up with a shortage of rentals. And to be fair, overall at the moment we do have a shortage of rentals, but there's a lot of factors that feed into that. So yeah, I guess we'll see how it plays out. I think overall, as you said, it may not be a bad thing. It's just we may have some pressures on the rental market over the next year or two as the market normalizes post-COVID. So we'll track how that goes. Third story so this is something a little bit different from Japan Times. So population is falling in Japan. I think as well, this is a challenge for a lot of countries. Like my brother has been in South Korea for the past decade. They've got a similar problem. If you project out to the middle of the decade without much in the way of immigration, birth rates are very low, population's falling. So Japan's population shrunk for the 15th year in a row as the country continues to grapple with a chronically low birth rate. The number of Japanese residents fell by 861,000 from a year before. That's 0.7%, marking its steepest decline ever to 121 million. So I haven't spent a whole lot of time in Japan. I mean, it's interesting, very Tokyo-centric, but the number of foreign residents rose by 329,000, or 11%. So that's a record high. So I think it's a relatively recent thing in Japan that immigration is starting to pick up. I think the demographic collapse is obviously causing some concerns. And I think, look, this has been a real challenge in Europe of late. A lot of high-profile news stories about tensions with immigration. But I think the European countries have... well, I guess we're generally, as Europeans, more used to immigration, but there are some countries like Japan where it's been less common, and that will create some tensions. So I guess just quoting from the article, since peaking in 2009, Japan's population has been in constant decline. The number of deaths in the country was the highest since the ministry began collecting data in 1979, while the number of newborns hit a new low. And finishing the article, if this trend continues, over 40%, this is just unbelievable, over 40% of municipalities may vanish by the middle of the century, 2050. So pretty interesting stuff, eh, Chris?
Yeah, I think once towns start to flip from population growth to population declines, right, it's not a great environment to be investing, right? If there's less people and less demand every year, it's hardly the fundamentals you want. So you're better to leave that town and go and start a business in an area where demand's increasing each year. And so I wonder, population is decreasing, but does it increase at a much faster rate in certain pockets around the country? I mean, there's been ghost towns like Detroit around in the US where, and even parts of Australia when, an industry or a mine or a power plant or a car factory sort of close, how does it affect the town? And so, that would be my worry, is that, as we start to shift populations around the world, and particularly Japan, I think we've got an aging population as well. So yeah, people are dying and population is decreasing, but they're also getting a very heavy older population, which isn't usually great for growth, etc. But yeah, I agree. Maybe that's the some of the answers to that is encouraging a lot of people from around the world to move to Japan. But also, I mean, you want to go to a country where the economic fundamentals are really good, and so that could be a challenge for it. But yeah, I think Australia's a bit different, right? We have a very high immigration policy, particularly at the ages that we want, right? Even student accommodation, a lot of people talk it down, effects on rents, etc. But if a uni student does come here, yeah, they pay for their education handsomely. They add money to our economy without sucking much out of our economy in terms of government support. Then they get trained up by our universities, and then some of them stay and then start paying tax in terms of on their income. And so I don't know if it's such a bad thing. Yeah, I mean, it maybe affects our rental accommodation, but is it good for long-term growth when we get someone, we haven't paid any money for any education for 18 years, then they're paid a fortune to our universities, and now they're in our workforce adding value? I can't see that's such a bad thing.
It's pretty interesting stuff. I think, there's parts of Europe where this could potentially become a big issue as well. If you look at countries like Germany, the dependency ratio could come under a lot of pressure there. And I guess the potential offset is by ramping up immigration. You mentioned, I'm pretty sure we talked about Detroit on another podcast sometime. But you might well get cheaper housing, but then you've got high crime rates and businesses going under, and it doesn't become a very attractive place to be, let alone to own property. It just becomes a disaster. So, yeah, I mean, the demographics challenge is low birth rates, low fertility rates in developed countries. And I think there's a number of countries that have really gone hard at this. Australia, New Zealand, Canada, UK, US to some degree. Australia, as you said, we seem to manage immigration comparatively well. Got a strong demographic pyramid. I think generally as an investor, you want to invest, I guess, in a place with population growth, inflation, because the debt gets inflated away, and then you target the sort of the landlocked areas where population's growing, people are getting wealthier, and it all kind of works pretty well. But if you've got the reverse, it's pretty different. So look, we mentioned Melbourne already. I'll just reel off a couple of stats here. The ABS reported that Melbourne's population, this is from Macro Business, increased by 1.7 million people, or 49% between 2001 and 2023. That's primarily due to net overseas migration, i.e. immigration. The Victorian government predicts that Melbourne's population will reach 9 million by 2056. So I guess this is the exact opposite end of the scale from a country like Japan, where you've got an accelerating decline in the population. If anything, Australia's gone the other way, and population growth really picked up during the mining boom years, but it's just gone on now. It seems to have become baked in, the idea that we have very high immigration rates on an ongoing basis.
Yeah, and I think it's we can't really change the system that we've created, Pete. What's some other stories you've sort of seen around the traps, Pete, in the last, before we wrap up? Any other stories that come to mind?
Well, I guess, yeah, all of the media is really sort of building up towards the inflation figures. So you'll have all of those before Sunday. I think in the property market, I was just looking at the auctions over the weekend. Melbourne's in a bit of a slump at the moment. Sydney seems to be holding up relatively better, but not booming by any means. And if you look at other parts of the country, well, we talked on the Q&A episode I recorded this week about the Perth market is in full-blown boom phase of the cycle, up 25% over the year. And although building approvals are starting to pick up now for Perth, it's going to be some time before that massive chronic shortage of housing is addressed. So yeah, Brisbane's still sort of powering along, and other parts of the country somewhat mixed. So yeah, it's been a very interesting cycle. I think it's absolutely wild when you look back 5 years of what we've been through over that time. There's just no way anybody could have predicted the various nuances of what's happened. We've had low interest rates, much higher interest rates. no population growth and then a boom in population growth. It's just, I think it does suggest you do sometimes just need to zoom out as a property person and try and think in sort of 5-10 year chunks and not try and get too caught up in what's going on week to week and month to month.
Yeah, and I think we're coming out of the winter time, right? It's usually pretty dire, June and July. It's been a cold winter. Listings are always down at this time of year. And as the sun warms up, usually the property market gets a bit more exciting with more listings, and people are way more active once August, sort of September comes around. And so I think that's another thing just to comment on, is that we're starting to get to that point. We can start to see some articles start to come out. The vendors need to adjust their prices to meet the market. There's always agents who talk up listings at this time of year. We've got heaps coming on, definitely list prior, so they're all trying to front run listings. I wouldn't be surprised if we do see a little bit of a spike in listings early in the springtime, and then it die off like it has in other, periods. We're late in the autumn / spring cycle, is that the listings just dry up because there's just not enough demand, or there's too much uncertainty for sellers to list that late in the cycle. So, it's going to be over the next month or two, just how many properties come on, what comes on, and if we do see a little bit of that upgrader in the market, or if they just think, there's still too much uncertainty, rates are still too high, there's been another rate increase, I'm just going to sit on my property, and then we're going to all be disappointed with what comes on it the next 6 months. And buyers are just either going to have to meet market and buy something that's not perfect, or they're just going to have to sit it out and wait till next year. So, let's see what happens over the next 2 months with listings.
Speaking of cooler times of the year, Chris, it's 39 degrees in Rhodes this week in Greece. So I've got a plane to catch. I better run. If you've got any comments or feedback, or if you want to have a chat about anything, I'm Pete Wargent, Alan Wargent Property Buyers, link in the show notes, and Chris and the guys at Flint Group for your mortgage needs are always happy to have a chat. So, Chris, have a ripper weekend, and chat next week. Enjoy Greece. Chat soon. Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.